Chat is making one final test that I can try to cook before the final exam. Gets me a little bit locked in. I already downed a monster like 20 seconds ago. Coconut water for potassium, and we're just gonna grind. Come on, hurry up. ChatGPT. We're not doing the test again. We're doing some fucked up hard questions. And I think that's prep. Yeah. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Hurry up, chat. Chat, hurry up. Okay, we're gonna start. Base rate equity threshold has aggregate return below 50 million at exactly 80% of its accessible income is base rate entity passive, assuming all requirements are satisfied. Which tax rate applies? 30 because passive, 25 because it is no more than 80%. B. One sec. Tao gọng kích luôn. Okay, D. Counting profit before taxes, that deductible interest is 200 grand. Deductible arm's length royalty expense. What does arm's length mean? Arm's length deductions mean. I don't get it. Counting profit before taxes, that deductible interest is that deductible arm's length, non-deductible debt provision, non-depreciation, tax depreciation is that. What is taxable income? Motherfucker, what? So taxable income is my tax depreciation is 310 grand. Counting depreciation, tax depreciation, tax depreciation, tax depreciation. What am I looking at? 5.2 mil. Non-deductible entertainment. You don't deduct any of that. Do you add that in? No. Or is that an expense that you have to add back? $5.2 minus 500K is 4.7 mil. non-deductible debt provision. Accounting depreciation. The fuck is taxable income, by the way? That's probably like 2 mil. 5.2 plus 90 million plus is that 5.2 mil plus 90k plus 40k plus 260k minus 310k. So you accounting profit before tax. Okay. Account profit before tax is equals to EBT, right? Equals 5.2 mil. Then you add this, you add depreciation back, counting depreciation, and you subtract 310 grand. Is that how they solved it? Minus 310 grand. Adding account depreciation plus non-deductible. Also minus tax depreciation. We're also gonna see if they've replied to our email, our forum. Please, please, please. Oh, a reply. Okay, please complete what we've actually covered in the iteration of this course. Thank you. Thank you. Thank you. Thank you. Thank you. Thank you. Good tax design. Related party royalties may allow profits to be shifted to a lower tax country, allowing restricted. Wait. 2B, right? Allowing unrestricted profit shifting improves horizontal equity. No, it deduces. So I'm gonna do 1, 2, 3, 4. So related party may shift it to a tax country. That's correct. Allowed unrestricted profit improves horizontal equity is wrong. It makes horizontal equity worse. Horizontal equity is the same for a lot of people, but no. Transfer pricing rules may protect tax revenue but reduce simplicity. Yeah. Transfer pricing rules. Yep. Certain transactions mainly to minimize tax is an efficiency concern. 134. C. 24. The board receives monthly reports, identify control failures, and follows up remediation actions that are overdue. This represents a form of, if they receive monthly reports, it'd be monitoring. D. Monitoring. Right? You've got reviews, checks, follows up. Risk assessment versus control activities. Management identifies a new risk of fraudulent supplier payments and evaluates its likelihood. It then requires 2 managers to approve every new supplier. Identifying the risk is a risk assessment. Dual approval is a control activity. B. So Q5 is new risks, right? Possible consequences. That's risk assessment. This is still just monitoring. Independence threats and now promotes a client's shares advocacy. Is that why? An auditor's spouse owns shares. Self-interest. Sure, you could say so, right? A dominant client management intimidation. Self-interest. That's self-interest. Would you say 2, 3, and 4? I think it's all 4 then. But there's no advocacy, right? No advocacy anymore. Material mistake uses incorrect depreciation method, resulting is material but confined to bills not pervasive. Management refuses to correct it. Proper opinion is qualified. A scope. An auditor cannot obtain sufficient appropriate evidence concerning revenues and material and pervasivity. Cannot obtain though. Possible. We're doing disclaimer. 8D. 9. Dividend declaration. Company declares a cash dividend that has not yet been paid. What's the immediate effect? A cash dividend. Well, 9, Q9. Cash dividend means on the retained earnings section, you declare dividends, right? So that takes a hit on RE, not yet paid, right? Which is a increase in dividends payable as a liability. What do you say? Profit margin decreases. Profit margin stays unchanged. But, oh, what a good question. What the hell? What does profit margin do? Profit margin is unchanged. One of these two then. Current ratio decreases or increases debt to equity. What's debt to equity? It's debt to equity is total liability over shareholder equity. Is that right? shareholder equity decrease? Retained profits does decrease shareholder equity. If RE decreases, is that right? RE decreases, you've got new dividends payable as a liability. So RE does important, super important. Does RE affect shareholder equity? Do dividends affect shareholder equity? If it is declared, does equity drop? Retained earnings, part of equity decrease in current liability account dividends. Total equity drops at this step. Yes. But if it drops both, does that equity increase? Is it larger than 0 or no? Current ratio is what? Current ratio is current assets over current liabilities. This doesn't change. Current liabilities increase. So current ratio decreases. B, 9B. 10. Inventory costing 110 grand is sold for 30K cash. Because the company was probably had a positive current ratio before the transaction. Profit margin increases. Current ratio increases. Debt to equity decreases. It was profitable, so profit margin should decrease. Right? If the company was profitable, let's say at 30%, right? Let's say PM was 3 on 10. Right? This is on sales. And your profit is now like 4 over 12. Right? So this is 0.3, this is 0.25. So your PM decreases. Does current ratio increase or decrease? But your inventory has to also decrease because you're switching inventory for cash, but you get way less cash. And so your current ratio decreases. I'm gonna do B, 10B. Yeah. Collecting an existing account receivable has no effect on total current assets and therefore has no effect on current ratio. Collecting an existing account receivable has no effect on total current assets. Yes, 1 is true. Right? Because cash down, okay, cash up and accounts down. So same current current asset. But if you collect a existing account receivable has no effect on asset turnover because neither revenue nor total asset changes. Asset turnover is sales over total asset, right? So asset doesn't change. I agree. If the debt to assets ratio is 2/3, receiving a new bank loan increases to debt asset. Debt to assets is the same as total liabilities over total assets is 2 on 3. Receiving a new bank loan. New bank loan is plus cash plus current liability. So he's add 1 to both. we get 3 on 4 instead of 2 on 3. So increases debt to asset ratio, all three. Looks like it's the correct one. All three, 11B. Very good questions. What the hell? Good, nice sick question. Consider the following statements. Dividend yield can be calculated as dividends per share. Dividend yield is annual dividends declared per share. 12. Dividends per share divided by market price share. No, I don't think so. The fuck? It's all okay. Ratio. Dividend yields, annual dividends declared per share over market price. Why did you do it? Dividends per share divided by market price per share. Could you? Okay, yeah. Same. It could be expressed as a total ordinary dividends divided by market value of ordinary equity. Ordinary dividends divided by market value of ordinary equity. Total ordinary dividends divided by market value of ordinary equity. So he's arguing that dividend yield, which is equals to annual dividends per share, right? And then they're dividing that on current share price, which is price market value of equity per share, which is the same as share price. And this is the same as total dividends. Oh my god! Or sorry, total dividends here and MVE here. So I think 2 is correct. 1 is correct, 2 is correct. How about 3? If dividend yield remains constant while share prices fall, dividend yield increases. Yes. And if dividend yield measures the dividend component of return, not the investor's complete return. Dividend yield is how much money you make, right? Dividend component of return, not the investor's complete return. I think all 4 works here. 12D. That's a very good question, by the way. I really like that question. I want to talk about confidence level number 4 is, I don't know, Q13. EPS and PE. A company reports profit after tax of 4.8 mil and preference dividends of 300K. It has a 1.5 million weighted average order shares and market price of $18 per share. So EPS for a company sitting at what? So you're gonna find PE multiple maybe? We have net profit and 18K. Okay, so we have NPAT, sorry, is equals to 4.8 mil. We also have MVE, which is to $18 per share times market price of 1.5 million shares, which is what? 18 times 1.5 gives you 27 million. Then MVE NPAT gives you 27 on 4.8, gives you PE equals 27 divided by 4.8, gives you PE of 5.625, and that 5.625 is equals to something on EPS, which is what? Market price per share is 18, right? We're going to swap. EPS is equals to 18 over 5.625. 5.625. Which gets us a EPS of $3.2 and a PE of 5.63 times. So A, EPS, it's A. Good question as well. The hell? Enterprise value multiples. Which one is most accurate? A has higher EV over sales, but same EV over enterprise value over EBITDA as B. A also has a higher EBIT margin. EBIT. So we're going to calculate EV over sales for A and B company. EV over sales, 900 mils over 300 mil is 3, and B has 800 over 400, which is a 2. Okay, so it has a high over EV sales. Does it have the same EV over EBIT, which is EV over EBIT equals 10. A also has a higher EBIT margin. $14A. Cold, bro. Accounts payable turnover. Company reports COGS of 720 grand. Beginning inventory of 100,000. Chat is just blessing me with a bunch of like unfamiliar questions, brother. Assuming all purchases were on credit, accounts payable turnover and days payable are approximately 7.58 times. COGS of that, inventory of that, ending inventory of that, accounts payable of that, ending accounts payable of that. Okay, 30 grand changes in accounts payable, 30 grand, 40 grand changes in inventory. So an extra, what? Assuming all purchases were on credit. accounts payable and turnover and days payable are approximately. Okay, so I should not be looking at wow, this is a hard question. What the fuck? COGS over inventory when? I'm not doing inventory change, is it? Accounts payable turnover. Accounts payable. End of the year, right? 7.2. How much is COGS over ending inventory? 720 divided by 140. 5.14. That's wrong. Not 18 times either. COGS with beginning inventory and ending inventory. So I have to calculate the total inventory that it had this year, basically, right? So COGS 720K. Beginning to end in inventory is 100K to 140K, which is a net change in 40K, and begin accounts payable to end accounts payable goes from 80K to 110K, which is a change of 30K. It must be balanced somewhere. If you think about it, we said all the purchases were on credit. So how much did he actually use? He used, I mean, there's 40 extra K, right? So this is on top of here. So he has total inventory and COGS of that and that at the start of the year. Accounts payable is an extra 30K now. And ending inventory is an extra 40,000 now. Cost of goods sold 720,000 this year. So would you say it's like, then total COGS is total COGS less? What is this? Where is this 70 extra thousand go? It is a, well, this is a current asset. Basically, current asset increase 40K, current liability increase 30K. There's an extra 10K. Share equity is equals to A minus L. If current asset were to plus 30, plus 40, and current liability were to plus this, then COGS would be 710,000. 710 divided by 100. 140. 710 divide 140. Good question. I don't know. Purchases were that plus 140k minus average payable is 95,000. You add the average payable is 95k. What the fuck? 710k. Why he plus 140? Can you explain to me question 15? In my head, I'm like, there's a change in 40k for current assets, change in 30k for current liabilities, and COGS this year was 720 grand. So we had an initial inventory of 100k, right? Let's say, yeah, very unfamiliar question. Help me explain that one. It's 12. Bitch, hurry up. I ain't got all day. Why you thinking so much? The company started with 100k and finished with 140, but the company also used costing 720,000. Therefore, it must have purchased enough inventory to replace the $700,000 that was sold and add another 740 to inventory. Accounts payable increased from 80 to 110. For the turnover ratio, we do not use the 30k change. We use the average amount owed during the year, which is 95. That means the business, so it's the total over average accounts payable. So you can use average over everything here. Average accounts receivable. If I do see an average, that may be pretty good. Wow, very interesting. So you're saying that for me to calculate the total amount of credit purchases, I'd be looking at the cost of goods sold and kind of the total change after the total existing inventory right now, right? That will give me a representation of how much I've sold this year, or at least how much credit I've bought, or yeah, credit purchase I've bought this year. And so for, I'm assuming days payable, accounts receivable, these two, if they do give me a question on like starting and ending time for days payable or accounts receivable or accounts payable, I can find kind of the average accounts payable or accounts receivable, uh, and then use that as the approximated amount. Is that correct? Okay, cool. 16. So 16 FCF. Consider the following statements. FCFF represents cash available to both debt and equity investors. Yes. When starting for EBIT, depreciation is added back while capital expenditure increases in net working capital are deducted. Starting with EBIT, depreciation is added back, yeah. Capital expenditure and increase in rent are deducted, yes. Interest expense must be deducted when calculating FCF. Wrong. Doesn't matter. A higher current year FCFF always means a company is more valuable regardless of risk or future cash flows. I think so. 1, 3, 1, 2. Not 1, 2, 3 only, and not 2, 3, 4 only. That looks like it's 1, 2. They say it's wrong. $16. What would I choose here? I'd probably choose 1 and 2, which is A, 16A. And then I'm circling red 15 because that's pain in the ass to fucking find. Average days payable. Okay, 17 now. Terminal value. FCFF in year 5 is forecast to be 12 million. Okay. After 5 years, FCF is expected to grow at 3% indefinitely. The WACC. The fuck is WACC? I've seen it before too. WACC. Working asset change in capital. Fuck me. Wow, valuation might be hard. Drive. Give me some shit about valuation, brother. Moodle. It's that WHOC or that uses of cash thing. That's for sure the part where it's like, what the fuck? FCF estimation. Give me my materials, bro. FCF estimation. What's WA? Whack. Fuck. Value of debt is determined by expected future cash flows to lenders. uses of cash should be the same as sources of cash. Okay. I guess. Generated beyond the forecast horizon. That's forecast FCF plus the terminal value. Terminal value is the value the firm could be sold for at the end of the horizon period. Terminal value is the value of the firm at the end of the horizon period. It runs a single value capturing all future cash flows beyond the horizon. It is an enterprise value. Its terminal value is an enterprise value. We're using certain EV multiples to calculate, hey, how much would the firm be sold for? And you'd use something related to that. And terminal value would be the forecasted period FCF plus the terminal value. Terminal value is that. It's an EV. Okay, so they use the total number of cash flow. They use the enterprise value. Is the performance at the horizon. They're looking at the EBIT or the EBITDA at the horizon. And they're seeing, hey, okay, if I were to just estimate the sales of the company for the next 30 years, I'll be able to say, oh, okay, well, that right now the firm has an EV or sales multiple of 6. Then 30 more years, I'd be valuing the firm at like 180 million. So that's the terminal value. I'd be valuing it today at 180 million for now. Plus the free cash flow this year. Okay. Financial health of the firm's estimated cash flow. Okay, now that I have that in my head, terminal value, what's WACC meaning? Weighted average cost capital. Discount rate in cash flow analysis to see what a company is worth today. FCWF is expected to grow 3% indefinitely. Indefinitely. Terminal value is EV over EBITDA or some shit. Terminal value is 206 million. How do I know? FCF is that. Terminal value is 133 million. Once again, 12 million times at a 1.03 divided by 0.06 is a $206 million terminal value. So is that C or B? It's B. Why is it B? And must be discounted to the present. So forecast is that 12 of that times the terminal value. Oh, 1.03%, right? Divided by weighted average cost capital. Weighted cost cap. FCF is supposed to grow. Right. Cool. Book value versus market debt. Valuation requires a market value debt but supplies only value, no information. What statement is more accurate? Can always be derived directly from. Nope, wrong. Book value and market are legally exact. Can I read? C. 18C. Tax table drill. Big curveball. In my mind, I think possible curveballs would be any valuation or FCF based curveballs that are just not written in the test yet. I think they might come from here or the normal valuation methods, but to me, I feel like they haven't talked about CCA too much. Terminal value is probably something relatively like uncomfortable to students. Also, yeah, that's what I think. What do you think? Maybe you could generate some possible MCQs from here. I know that the final part of the valuation and free cash flow estimation is your generic FCF book value of debt or the related information. So I'm not too worried, but maybe some MCQs. What do you think? So we learned a new average AP. We're gonna try to 18C, right? And 17B. So we're gonna look at our grades. B, B, C, D. Yep. B, C, D. 5B, 6D, 7B, 8D, 9B, 10B, 11D, 12D, 13B. What happened in question 13? EPS is $3. Why is it $3? EPS is tax and dividends, preferred dividends. Preference dividends. What the fuck? What are preference? What are pref dividends? Preference dividends are dividends paid to shareholders first. Preference dividends are paid to shareholders first. So you get 4.8 minus 0.3. So actually 4.5 M's. Then you divide by the average ordinary shares. So NPAT over number of shares is EPS instead of 18 million instead of Great. What's PE? PE, P on E. PE ratio? PE ratio, price to earnings ratio, is market price per share 18 over earnings per share. EPS of 3. That's why it's $6. Okay. Important question. I like the question. I like your questions related to PE ratios, dividend yields, um, debtor turnover days, accounts receivable, payable days, PS multiple valuations, and days ratios. All the days ratios are pretty good. I feel like they'd be just pushing all of those curveballs in the MCQs because all the other guys, all the normal ROE, ROA, DuPont ones are going to be covered pretty much in the test already. And so I think the rest comes from all of these other ratios that you're trying to prepare me for, which is good. So please continue with that. Okay. Company valuation statements. When do I have my test? Wait, 10 to 12. Oh, GG's. My test is at 1:45 to 4 p.m. Monday, August. Today's the day. Check your exam timetable for the time and location. Where's the location? My class timetable. My exam timetable. Paper, the Scientia Layton Hall. One forty-five. I need to get there by 1. Sorry, I need to get there. I need to go at 1. If not, I have to book an Uber. Or I should go at like, I should stand up at like 12:50. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, terminal value statements. Terminal value is measured at the end of the explicit horizon period. No, it is the beyond forecast. That's every single number. It captures the value for future FCS beyond the forecast horizon. That's the correct one. It represents the enterprise value. It is a type of, so I think 3 works. It should be normally estimated using PE because PE is based on earnings. 4 is wrong because it should be an EV based over EBIT. EBIT, EBITDA, or sales. So only what? I mean, 4 is not right. So are you saying that at the end of the explicit forecast period, but you said beyond the forecast horizon? I know it's going to be 1, 2, and 3, but just reading. Just reading terminal value. Forecast period free cash flows. Cash generated during the explicit forecast period, so over the next 5 years. This is all the FCF plus the terminal value. Oh, I guess you're right. Oh, okay. It is measured at the end of the forecast period. Yes, you're right. So remember this graph. It's FCF here, so how much money we could expect here. So FCF here, forecasted here, FCF forecasted here, and then the end forecast horizon. You've got the final FCF forecast plus the terminal value, so all the years after that. So it's 1, 2, 3, and yeah, just 1, 2, 3. Correct terminal multiple. Target company's expected horizon year results are EBITDA, EBIT, sales. Company trades at 8x EV over EBITDA. What's the implied terminal value? 8 times EBITDA, 40 to 30, fucking 4 times 336. Yeah, 336. Yep. Multiple averaging. 3 comparable companies have an EV over EBITDA multiples of 6, 7, and 9. So 6, 7.5. Target horizon is that. Using the peer average, estimated terminal value is 7.5 times 40. $300 mils. B again. The target horizon NPAT is 22 million. Appears PE is 14x. Applying this multiple produces. Target's horizon year NPAT is that. Peers PE is 14. Price of earnings. This multiple produces what? Price over earnings. And we have NPAT. Or PE multiple, sorry. Net profit after tax over market cap. Okay, well, P on E ratio is equals to 14, and that's equals to some value of capital, or some MVE basically, on 22 million. So our MVE is 22 million times a 14 multiple. Gets me 308 M's. It gives me a market value of equity of 308 million. B. A company's estimated enterprise value is 520 million. Its market value of debt, and it holds 35 million in cash. So EV is 520 million is equals to our MVE plus how much debt? $140 million in debt minus $35 million in cash. So we have MVE is the same as 520 subtracted by what, 105 maybe? So that's 415. C, 415. A complete FCF calculation finds that EBIT is 120 million. Wait, do I remember what I just did earlier? I did the average question, right? Question average. And dividends payable does affect equity. It does drop. And question 12 is very sick because you've got dividend yield as the total dividends over the market value of equity. And 13 is if you have preference dividends, you could subtract them. Six, a company reports EBIT of 120 mils, tax rate of that, depreciation of that, capital expenditure of that, and operating net working capital has increased 18 million. FCF is what? EBIT times tax rate. So FCF is 120 times 0.7 plus 20 minus the quantity of 35 plus, that looks like 18. 120 times 0.7 gives us 84 plus 20 minus 35 plus 18. 35 plus 18 gives you what? 53 minus 53. So you've got 84. Sorry, let's do 104 minus 53. Which should give us like 51. So B, 6B. Depreciation curveball. Depreciation expense increases by 10 M's. Consequently, EBIT falls by 10. Okay, other remains, and tax rate is that. Depreciation expense increases 10 million. EBIT falls by 10. I'm pretty sure you get like a little bit more tax savings. I think there's an increase somewhere. If depreciation expense increases by 10 million and you're going to subtract 10 million, you basically get an extra $3 million. Yeah, you basically get an extra $3 million. Yeah. So your tax deductible is a little bit less. Working capital movements. Accounts receivables that current year is this. Inventory last year is this. Inventory this year is this. The change in net working capital. Accounts receivable is an increase of 12 million. Inventory is a decrease of 5. So we have 7 million positive right now in net working capital. Accounts payable is 13 million. So 7 minus 13 is minus 6. So our net working capital has decreased 6, but our FCF does increase by 6 as well. So 8 is a B. 9. Notes payable trap. Notes payable. Would notes payable be same thing as accounts payable? Right? So any type of payable would be a good amount of money that we need to take out. So accounts receivable, or net in accounts receivable, is 10. Net in inventory is 3. Net in accounts payable is 6. So it's 13 minus the quantity of 6 plus net in notes payable 10. That gets us 13 minus 16, which is change in net operating net working capital of minus 3. Minus 3, so C. 9C. Capital expenditure. Gross property, plants, and equipment increases from that much to that much. And there's no disposals. This course method gives a capital expenditure. Capital expenditure 0. Or, oh, sorry. You spend more money, right? And no disposals. So no accumulated depreciation, that means. That means I spent extra 22 million, right? If we don't concur depreciation, PPE change to a PPE of 190 M to 212 Ms is equals to a net capex of 22 Ms. $12.40. 10 more minutes maybe. Interest expense curveball. An interest expense increases from 5 to 8, but EBIT and all operating and reinvestment figures remain unchanged. What's the most accurate? Interest expense increases, EBIT and reinvestment changes. I see no change at all. Interest is a financing item, so C it is. It's not a cash item. 12. Negative FCF. A growing company reports negative FCF, which is, okay, lack of free cash flow because it spent a lot of capex. Which conclusion the best? The external financing must be required. C. By the way, uses of cash and sources of cash. Sources of cash. It needs to be same as uses of cash. How do you find my sources of cash? Every form of interest, dividend paid. Is that correct? Dividends, interest, and balance. Uses of cash is easier to remember because you want to be looking at uses of cash via dividends, interest, and cash. Dividends, interest, and cash. Dividends, interest, and cash. Dividends, interest, and cash. Cash, you can find, here's how much money I have. Here's how much cash I paid on interest debt. Here's the amounts I paid out. So I used a total of $10 million in cash alone. Okay. C, right? 12C for FCF. 13, book value of debt valuation requires market value. Book value could use as a proxy. 14, select the correct statements. Assuming we have a positive earnings before interest and tax and other things remain constant. Higher operating expenses reduce FCF because, okay, higher operating expenses that reduces EBIT for sure, right? Because more expensive, more expenses. Higher tax rate reduces FCF. A higher tax rate gets your NOPAT down way more. Yeah, I agree. Higher accounts payable increases FCF. A higher accounts payable. Yes. Lower accounts receivable increases FCF. Yes. Higher inventory reduces FCF. Higher inventory. Yes. All five look correct. $14D. Terminal value timing. A company explicitly forecasts FCF for the year. Its terminal value is at the end of the forecast horizon. Under the week 7 presentation, terminal value should be added to the 2029 FCF as a value beyond the horizon, which is B. Okay, let's check. B, 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 B. 4 B's in a row. 1B, 2B, 3B, 4B, 5C, 6B, 7C, 8B, 9A, 10B, 11C, 12C, 13C, 14D, and 15D. Okay, we're good. Okay. I checked the course ratio list, and there are two important exam conventions. COGS payable, not purchases over accounts payable. Here's an 18-question curveball set focused on weaker ratios. You might want to look into these ratios as well. $12.45. Hour before exam. I'm officially an hour before exam. Could I do this test real quick? Sure. Should I prep and just go to school? I could prep and okay, I do need to take a shit. What do I think. NPAT 15 mil, 10 mil share price 30, P/E ratio. Remember, most cases you'd be using earnings ratio because PE multiple is your market cap over net profit. So it's a multiple that you're using to evaluate. Your PE ratio is the ratio you're using a lot more for financial purposes. NPAT of 10 million shares and share price of $30. PE ratio is market cap. Okay, what's my PE multiple actually? Maybe I do need this question. Company has an NPAT PE ratio is market price over EPS. But I don't think we could find that yet. But we do have market cap, so we could use a PE multiple to find market cap out to find a PE multiple. Sorry, no. We can find EPS right away. EPS is equals to earnings per share, which is NPAT. Oh, okay. Wow, see? And shares. So PE ratio is basically MP, market price, share price, over NPAT over number of shares, which is the same as share price times number of shares on NPAT, which is 15 M's times number of shares, 10 million shares, $15, sorry, share price of $30. $30 times 10 million shares over 15 million. So that's 2 on 3. 30 times 2 on 3 is 60 on 3, which is a 20x PE. Okay, fuck. I need a page for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4. 3, 4, 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4. PE ratio 20 is a C. For trailing PE, shares trade at $36. Last year's EPS was $0.8. Forecast EPS. Ooh, forecast EPS. What the fuck is a fucking trailing PE? Do we have forward and trailing in our valuation? That might be so important as well. 1250. Be a company valuation. See if we have any trailing related PE. Trailing forward. Shit. This might be the next important motherfucker. Come on. Valuation and trailing. Calculate different financial ratios, relative multiples, and group assignment bullshit. Wait, before I get into any of these questions, I only have like another 5 to 10 minutes of actual, like, maybe like 10 more questions worth of review. So these are the slides, and you can also see the learning outcomes here. So just make sure that we're not doing anything that's like unnecessary. And yes, I'll do your 18 question set, if you can make sure to me that all of it is like going to hit the correct points in the slides. I do need to take a shit, fat shit. ID. 1 to 4. So still do 1 to 4, right? Forward versus trailing PE. Trailing is the year before prior, and forward is the continuing year. So sales trade now at that, and EPS was that. Well, forecast EPS. Okay. So PE, wait. Okay. So they want to calculate, they want to see if we know what trailing and forward is. Well, trailing is last year. So PE is market price per share over EPS, which is 36 on EPS of 1.8. Oh, that's fine. It's like 20. Yeah. So that's 2B. 3. Company's annual DPS is what? Fuck. DPS. Dividends per share. Dividends declared per share. Falls. Dividend yield rises from a certain percentage to what? Well, price falls. Well, DPS is $1.20 right now. Divided from divided over $24. Yeah, so that's dividend yield ratio. 1.2 divided by 24 gets you 5%, and then we're dropping the price $1.20 to 20. 1.2 divided by 20 gets us a 6%. Dividend yield is 6%. C. Dividend yield measures annual DPS relative to current price. That's what just happened. Yep. Dividends are only one component of shareholder return. What's another component of shareholder return? What's another component of shareholder return, brother? It looks like all 4. A higher dividend yield guarantees higher total shareholder return. 4? Looks like D. Guarantee? Oof. No. Not all 4. 1, 3, 4. We have to be sure that not guarantee, because there is a possible information where the dividend yield does increase. And I've drawn a dick. Well, I'm just... 4 is no guarantee. 5. Cash sales. Credit sales remain unchanged. Cash sales or credit sales remain unchanged. What happens to debtors turnover? Credit sales over accounts receivable. C. 6C. Tell me 6C is correct. Oh. CBCB. CBC. CBCB. A high yield does not guarantee total return. Yeah, that's what I thought. Oh, okay, never mind. Yeah. What I read it, I answered the question wrong. That's my fault. It's fucking 1. I'm going to school. Goodbye. Or at least I'll chat GPT on the way.